In this video, traders, we're going to look at what's the logic behind the head and shoulders chart pattern. Stay tuned. Hey guys, well, welcome to you. Thank you so much for joining me. Okay, so head and shoulders, you're probably familiar with this, right? You've seen it in all the textbooks. You've seen people talk about it. If you're on any of these platforms like TradingView and all the others where people are sharing charts and what have you, you would have seen head and shoulders as a real common and popular thing to trade. Now, with any of these chart patterns, there's always an element of validity to them. Okay, now some of them, maybe there's some are better than the others, but that's subjective, right? But there's always something to them, i.e., there's a logic behind them. I like to think of the logic, and I always like to step back and play, an observation game and think, hey, I want to look at everything through the lens of supply demand. About what lens are you observing the market through? And for me, it's this supply and demand lens. So whenever I see a chart pattern or wherever I see something that is a setup or a strategy, whatever it is, I like to translate it into supply and demand. And I think that's key. And it doesn't have to be necessarily supply and demand, but obviously that's the auction process of the market. But I think being able to do that and put it into the context of, well, what does it mean? It means that you'll have more confidence when you're about to trade it. So if you want to trade this head and shoulders pattern, if you want to trade the inverse head and shoulders pattern, then you go, okay, well, understand the logic behind why I should trade it. Because I don't know about you guys, but when I see something and someone says, hey, that's a great thing to trade, it's a great pattern, especially as a beginner, and now I can kind of look at it through my lens automatically. But as a beginner, you're like, well, why? Why would that pattern be anything? And people show you all these cherry-picked examples, and they look great, but in the real world, you kind of see one doesn't work, it's just any other. And what it does is it helps you put it in context as well. And I'm a big fan of understanding the context of where you see these chart patterns and why you see them. Also, I say where you see them and why you implement them. So what's the logic behind the head and shoulders chart pattern? So very briefly, we're on the head and shoulders, guys. Here's our shoulder here, here's our shoulder here, and here's our head. And we've got this push up to the highs, push up past that prior high, fails to push up and goes lower. And this is generally known as the neckline. So you've got this, you think about what's happening. Demand, 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 starts to fail, comes back down. But any time frame, by the way, finds some support again. Then there's more demand, which takes out the high. Now, if you imagine you're on the hard right of the chart, if you imagine you were here, for example, what are you going to see? You're going to see, oh, this is like a solid uptrend. And so bulls are getting back into the market, sellers are getting, shorts are getting stopped out, etc., etc. All the reasons that we tend to see why a market would trend. And there's a presumption that the trend is going to continue for most. Okay, then when it fails and comes back to here, now so far so good still, right? Because if you're a bull, you don't mind that so much. It hasn't breached the low. Imagine this, it's gone up, it's done this. So far it's just come here. That's not necessarily reversal. You wouldn't really prefer to have to see it stop there, but it's not the end of the world. And then when it pushes back up again, donk, as in this part here, you go, okay, off we go. And your expectation as a buyer is for it to take out the highs, right? That's a classical trend type scenario. But it doesn't. It comes back down and it retests this neckline. Now, the traditional textbook would say you go short on a break of the neckline here. Let's put a short there. You go short on the break of the neckline there. And if you want to, you can extrapolate out this distance between the head and the neckline to the downside and use that as a target. Okay, fine, textbook. But the point is that what's the logic of the pattern? And again, let's just go back to where we were a moment ago. It's taking out the high, it's coming back down, everyone's happy, it pushes back up, it starts to fail, and what happens now is a disappointment to the buyers. There's a supply-demand imbalance, yes. People think that the supply coming in will be overtaken by demand pretty much. And when it starts to break through this neckline, you've got a lot of people with a lot of stops under this level because it's become such a significant level. The buyers who are late to the party, who have chased it on that shoulder, are now probably coming out. The buyers who kind of make the FOMO'd into the head and kind of stuck with it are definitely coming out if they're that way inclined, they're short term in nature. And anyone holding this is kind of saying, oh, maybe this is a reversal. But actually, if we look under the bonnet of what the situation is, we've got a demand, supply, better demand, supplies come back, half a demand, and there's not enough demand to take out that prior high. And that's given us a glimpse into the fact there could be a reversal. So that's the logic behind it. It's that demand, excess demand, not quite a strong demand, and then it kind of dawns on people that this is not exactly, it's not the market they want, or this is not the conditions they want, it's not got the strength they want. And very often we see this at the end of a trend. So that's why I like this in those type of scenarios. I don't like this in a range. If we're in a range, we see head and shoulders, who cares? Doesn't mean anything. If you're at the end of a kind of stretch market, duration strong, range is strong, all that type of stuff is strong, then you see this kind of playing out. It can give you an insight that perhaps it's a reversal in place. And so, or reversal about to take place, should I say. So, you start to understand the logic behind it. So let's look at some others. So the inverse head and shoulders here. You guys probably know all about this. This is the head and shoulders, just flipped up, flipped in reverse. You've got your shoulder here, you've got your head here, and then you've got your right shoulder here. And the same type of thing as you would buy a break of the neckline there. Now, sometimes we get grubby ones, by the way, excuse my scrawling on here. Hopefully you can kind of see what I'm trying to say. Sometimes we get ones which are, at an angle like this. So there's a slight angle to them. But again, the concept is still the same, right? Supply is coming in, demand is coming in, push to highs, push back to a low. More demand coming in, taking it to a high. Imagine what the hard right of the chart there, looks pretty good. Comes back, yeah, you're okay. It's kind of gone to a low. Maybe it's caught a few people out. But then we have one more shove, and then it's just giving it all up. And the idea is you're going short on the neckline there. So same type of logic. But in the real world, we often get these type, where you've got an uneven scenario, because it's nice to say you've got a nice even shoulder, a nice even head, and they do happen from time to time, but most of the time you're getting this scenario, which pen will I go for? Let's go for the red again. You've got your shoulder, your head, hope you guys can see that just about, and you've kind of got this push, pull back, big strong drive, pull back, reasonable pullback, but the logic is the same, right? The logic behind it is still the same. It's that demand coming in, supply stopping that demand, or demand shutting off, whichever way you want to look at it. It could be either way. Sometimes we just don't know why a market reverses. Then big demand coming back in, pushing, munching away all that supply on the offer, chomp, 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 pushing it to highs, comes back again, tries one more time, comes back again, and what happens is that demand is being met by supply at these levels, okay? And then when the third attempt, which is our final right shoulder, happens, where the sweet spot is, when we see that starts to roll over, that's almost like, okay, if you were a seller and there's a big batch of sell orders to conduct and you're kind of conducting them for a client, for example, when you said, you know what, I'm not going to wait. I'm not going to wait for that high. I'm going to hit it a little bit earlier this time. I'm not going to wait. And so that causes the stall a little bit sooner than the prior high. And then often this leg down here is quite quick, because buyers go, oh, I don't want to pay up because actually I might get it cheaper. Sellers go, oh, geez, I might not be able to get it, start hitting bids, and that cascades down quickly. And that very often causes a break of that neckline quite sharply, because this leg here, if you like, is a really strong kind of draft lower, just because it's like, oh, pushing, it's not going anymore, shutting off, demand shutting off, bang, and then you just see that rug get pulled and it goes to the downside. Final thing on these guys, textbook says short through the neckline. Fine, I think that's good, because you can obviously use a stop above your shoulder or above your head if you want to. If you're more advanced, you could have this and play this game of chess of saying, okay, how would that form? Would that form? And can I be smart about looking for I've drawn so much on here, let's do this one. How can I get smart about looking for a reversal at that shoulder? And you don't know where the shoulder is going to be, obviously, but if you start to see some kind of reversal, some sort of exhaustion that pulls back, some kind of, if you're watching that on a, daily chart, for example, maybe intraday, there's that intraday reversal that kind of gives you a heads up that actually this could be forming head and shoulders. And if you can position short before that goes, you can be in a nice position where you've got some cushion, and then if it breaks, great, you've got a bit extra juice and start of the shoulder, head and shoulders pattern. If it doesn't, you've still got something maybe you got in kind of earlier. It's just something to consider, something to consider rather than trading a textbook. Just think a little bit ahead of the game and go, can I position before that? That looks like it might form. I know that a lot of people say, oh, you should wait for it to form, and fine. If that's the way you want to trade, absolutely. But for me, I like to try to preempt a pattern. That's always given me better results when I've gone, is that going to occur? If it is, if I can position for it, and it's such a lovely position, that's when you start getting those 5R, 6R, 10R type trades. Anyway, guys, that's the logic behind the head and shoulders pattern. Hope that helps. Hope you get some value from it. Take your risk. Take care. Keep your risk managed. Bye-bye.